Hello, this is David Moore of Equity Advantage, 1031exchange.com, and I'm blessed to have Karlin Conklin of IMG Investments with us today. And I've been trying to make this happen for a couple of years, and she's been avoiding me. I'm just joking about that, but it's been hard to get you in here. I think you're a busy woman.
Been busy.
Yes,
Yeah.
definitely. So I've known Karlin for 20 some odd years. I think the first transaction we did, it was sort of baptism by fire.
Right.
We had a couple of clients, you had a couple of clients, twins, that were relinquishing, and this is stuff I remember. See, even though it's 22 years ago today, I remember this transaction. But the twins had roughly 8 different properties, and we did what we call a blended transaction out of those properties into, I don't remember what you sold them.
It was like 140 or 50 unit apartment building.
Yeah.
So it was 8 single families into the one. But why it worked is because the seller owned it free and clear, and he could be the debt as we went through this. I mean, if somebody had to,
So the reason that was so important in that transaction is we did, like I said, a blended transaction where you got a few of the properties sold, and then we had to buy, then we had to do a reverse out of the residual properties, and that required a reverse, which required financing that was sort of outside the box, and you got that deal done because you got the seller to carry. Yeah,
got it done. But
nicely done. Most people start off selling a house first.
I know.
Yeah.
So it was a little complicated. You know, the really to tie the bow on the story, those clients have remained with me for 22 years. And with Investors Management Group, they are tenants in common in 3 very large apartment buildings that are doing very, very well. So it's a lot of this with real estate, in my opinion, is relationships over time too.
So that says something a little bit about you and the way you take care of your people. And I've known you a long time, and you always do that. So why don't you tell us a little bit about, number one, if somebody wants to get a hold of you, just, best way to get a hold of you, and tell us what you're doing today. I mean, and how you got there. A little bit about IMG.
The easiest way to find any of us is with the company is at our website, imgre.com, Investors Management Group, realestate.com. And that has our track record and articles I've written, articles about us, all of that, along with any offerings that we might have at the time. And the other question was how did we kind of get to where we are?
I mean, how'd you end up there? And she just mentioned articles, okay? They're not just articles. You are actually a writer for a couple of publications. Kiplinger, I believe, is one, and you've done a lot of publication.
And GlobeSt, and we are a go-to for even Wall Street Journal. The real estate, in some respects, is the simplest thing in the world, right? You decide you want to buy a house, and you buy a house, and you live in your house, and all of a sudden you're a real estate owner. But when you get into large syndications, institutional grade properties, the complexities get larger, the loans get larger, the how you asset manage the building becomes more complex, and when markets start to change, like right now. There's a lot of folks that want to know, how are you dealing with real estate? And it's not just a little bit of change right now. It is astronomical change really, really fast with the Feds raising rates like this.
So for context, we are talking to you the day after Election Day in November of 2022. So when you're watching this 10 years from now, you'll know what we're talking about.
Right.
And then hopefully we'll have good stories going forward, not like the 07-08 situation, but anyway.
But it's dynamic. We had an investor event a month ago and had an economist as one of our panelists at the event. And what Josh said was as the Fed was entering the end of 2021, looking at 2022, everybody's, the indexes, SOFR, LIBOR, all of those, no one pegged inflation or rapidly rising interest rates that was going to happen in 2022. So we've had 4 consecutive pretty substantial interest rate hikes, right?
Definitely.
To curb inflation. And it's a shock to the system. On the other hand, realistically, we all knew this was coming.
Yeah.
Yeah.
So was that Josh from
Josh Bodine.
Okay.
He's one of the economists at
Got
Brookhaven.
it.
Yeah.
All right.
Yeah.
Interesting, because I had last Wednesday, I had Pat Stone, Wilson Financial Group, spoke at the CCIM chapter. So I'd sort of be interesting to compare notes on what they were both saying. But Pat, I sort of laughed walking out, because I said, if you didn't walk out of there feeling better than you walked in, you weren't listening to what he had to say. Now, whether or not he's correct, but he just sort of felt like this was an issue that we would be dealing with for the first half of 2023, and that the dust might settle after that, things start getting going. But he just sort of felt like a lot of this stuff was self-imposed problems, or that the fundamentals were still good.
Right.
It's just we had lots of stuff going on that was causing issues.
Yeah, and the other thing is, debt is a component of how you grow your wealth in real estate. Debt is a critical component, and it's how you place that debt. So with what we do at IMG, we started going lower and lower leverage as we entered probably towards the back end of 2021. Why? Because my partners and I, we all lived through the crash and the Great Recession. If anyone lost a piece of real estate, bar none, it was probably due to leverage. A loan was due, or you had to get out of a loan, and you could not refinance, because to go to the table, you had to bring cash. So in all the transactions we've done this year, I think we've closed $500 million this year in new acquisitions. Every single one of them, debt is about 55%. And so when you look at your returns you project are lower, because your debt is that one component, and we're suppressing it. We don't care. This is a way to grow over time. And in my opinion, unlike the stock market, real estate's a long-term game. We're not, putting it in today, watching it, and moving it to another index tomorrow. When you invest in real estate, short term is 3 years for us. We're typically 5 to 8 years with any kind of hold.
So it's interesting you say that. I don't know if you remember, those of you that watch our channel regularly hear me talk about one of my good old buddies, Bob Nelson, that we unfortunately lost this last year. But Bob made the comment, and if you've watched the channel, you've heard me say it before, it's like real estate is not a get-rich-quick scheme. It's a get-rich-slowly but surely scheme. And his position was, with one golden rule: never get yourself in a position where you have to sell in a recession. Never. So he definitely echoed what he always said. The other thing, I guess, while we're talking about, you talk about 55%. I just want to put something in the dust right now. People here, you got this term all the time. You got to replace debt in an exchange. And you might say, gee, the property I've given up, I've got 75%. Karlin just said theirs is 55. I can't buy it. And it's like, no, you can, all right?
Right.
And debt can go away two ways. One, by going down in value, triggers taxes because you went down in value. The other way debt goes away is by adding cash. So if you want to buy into one of Karlin's projects and you're currently at 75%, you need to be at 55, you're just going to add money offsetting the reduction in debt, and that's totally fine. And to be totally honest with you, that's going to happen every day in today's world, because in recessionary times, you've got lower loan to values, you've got reduced equity, and inevitably people have to add money.
And I'll say the sacrilegious thing, which I say to our clients every day. Okay, fine. You have to pay a little bit of tax. Get over it.
Yes.
The fact is, the tax advantages of real estate ownership are so extraordinary that whether it's the depreciation write-off, it's the 1031 exchange, it's all of those things, and a lot of it keeps on deferring taxes, so you can go 20 years and really not pay anything. So if you have to pay a nickel or two, honestly, it's okay.
Well, and it's not all or nothing.
It's right.
Right? So spend what you want to spend. Every dollar you spend more than you want costs you $1. If you don't spend it, it's 40 cents. So just get what you want to get and be happy with it. But
with our clients, our exchange clients, many of them started with a single family house, and then it grew into a duplex and a 10plex, and then they turned around one day and they were 65 and they realized they don't want to do sweat equity anymore, and so they do sell, and they've been exchanging that whole time. And I'll get a call and it'll be, Karlin, my husband and I really want to go on a trip, and I'm like, for heaven's sakes, keep some of your money. Maybe it's 50 grand. Go on a world cruise and you're going to be fine. And I'm because I'm not a spring chicken either. And this is the thing. Live your life. You worked your butt off. Take some of your equity. Live your life, right?
Yeah.
And so
like the old saying,
right.
the armored car and the hearse, right?
Right. And it's like, my kids, probably your kids too, they're going to inherit enough. Yeah. Have some fun.
Well, thank you for those opening remarks. Don't go away. David Moore, Equity Advantage, Karlin Conklin, IMG. We'll be right back. Thank you.